Good day everyone and welcome to Price Action Trading School. My name is Nenad and today we will talk about proper money management in the Forex market. So I need to say that the Holy Grail in Forex market does exist and it goes by the name of money management and risk management, and you will see that even if your entries are not as accurate, you will still be in a profit if you know how to properly manage your trade and do the proper money management. So you will also learn today why leverage is good for you, and by using a good leverage you can actually be in a nice profit but not overusing the leverage that is provided by our brokers. So definitely money management, I always state, is the single most important thing out of all important things in Forex trading. So before I delve deeper into the subject, quick risk disclaimer explaining that CFD and Forex trading are leveraged products and can result in losses that exceed your deposits. So it's not suitable for everyone. If you want to get corresponding information on charting conditions and any other detail, you should visit Other Markets Global, select your country of residence and contact an appropriate entity. So this video is not part of the .co.uk website but the globalnews.com website. So today's agenda: money management, the tripod, leverage, examples, and different trading styles. First of all, let's say that the tripod of successful trading has always been the most important thing out of all important things in Forex market. I will show what tripod is, but I'm sure that all of you who have been here with me in Price Action Trading School know what a tripod is. Also, guys, I know a lot of trading stories from traders who actively trade in Forex market. And I have personally met a guy who lost 3 years of profit in a single trade. So basically a guy was very profitable trader, and his account exponentially grew up until Euro Swissy thing happened. You know, when the Swiss National Bank decided to unpack the euro from Swissy or Swissy from euro, and they dropped the floor and Euro Swissy tanked in a second. So he actually had a very leveraged position in the market. His leverage was a bit higher than it was usual because he was hoping, as the majority of traders did, were actually they hope that Swiss National Bank will defend the peg, the floor, and that Euro Swissy will jump straight from 1.2000. Well, guys, it didn't happen. As you know, in a split second he lost everything he earned in 3 years. That is the story that I know of, but I also know, and I not personally, but I have read some stories of traders who lost also 5 to 6 years of profits in a single trade. So market is always volatile, and it's okay, but if you know what you're doing, then at least you should be protected from that high risk events. Because of that, as you know, Other Markets has developed so-called volatility protection setting that you can actually protect your account from big volatility. That is a very good thing if you are still not sure what to do with your money management. Even if you know what proper money management is, I still suggest you to download the volatility protection settings, because it's definitely a good thing to have, and it can save your day because if some important news come out or some important events come out of the blue. So it's very good thing to have, and I really strongly advise you to use volatility protection tool. It can be activated in your trader's room, and here, guys, you can actually read about this thing, why it's important, how does it work, and everything is also shown here. And also you can now enjoy 20% of spread reduction on euro dollar, pound dollar, dollar yen, Australian dollar, and gold. This is a great thing to have, so I really encourage you to open an account. It's called the standard account. This is that account that it has their spreads reduced, and you can also trade equities. I mean, it's very good because even when you trade with low spreads, you're still in a lower risk than you trade with a higher spreads. I will explain the subject during the webinar, so stay tuned. Okay, so very, very important thing is to have that volatility protection setting tool, and to know that even if you're a good trader, if you're a profitable trader, you still can lose money in a single trade. Also, guys, don't forget that well, as I said, 5 years of profit lost in a single trade, that can happen to you too. Don't think that you are invincible. I have learned it the hard way many times in my life. Really, I have learned the hard way that I need to protect my profits heavily if I want to make something out of the market. And I was more than right to know that if I use a huge leverage, it can simply knock me out of the market, and I will not have anything to trade with. So it's very important to understand the concept of both leverage, not then using leverage to your advantage, and risk to reward, and risk to win to lose ratio. Win to lose ratio also applies to big win versus big loss. If you want to have a profitable system, you should have at least 60% of successful trades. But if your successful trades are 30% of your overall trades, rest assured that by applying a good money management and proper money management, you still can have profitable account, because money management will help you to grow your profits exponentially. We already talked about it on compounding session, so please refer to compounding session. And compounding, it was recorded and uploaded on YouTube. And if you don't know what compounding is, let me tell you that it's a great thing to add profits to profits if you don't want to withdraw anything from your account. Compounding is a sort of investment. So for compounding, you should never ever let your big win turn into a big loss. And it can happen, guys. I know many traders who were greedy enough to go for hundreds of profits in a single trade, and what they usually have is they lost everything, because market is volatile, and simply said, things can change in a split second. So that is why it's important to go for a big win instead of a big loss. And usually retail traders encounter a big loss, not a big win. That's the hard truth, guys, but it's the truth. 90% of traders will usually experience a big loss instead of a big win. Market volatility is much higher than it was 5, 6, or 10 years ago. Because of that, some things have changed. You cannot trade the same way as you traded 10 years ago, 15 years ago, or let's say 5 years ago. Everything is changed, but it's a good thing if you know how to tame the market, how to tame the beast. You need to know how to deal with it. Tripod of successful trading is something that I am very, very proud of, and this tripod of successful trading saved me many times before in my life. A successful trading is based on a tripod of successful trading. That means having a profitable strategy, good risk management, and a proper trading psychology. If one leg falls, everything will fall apart. But having said this, guys, rest assured that the single most important thing is to set this task, and this is money management. Not to lose a capital and stay on flow for many years. Gradually multiply your equity figures and earn profits. Problem with many traders and people, they set the third task for the first task, and they start to lose. Success comes down to proper risk management, even if your trade execution, if your entries are not that good. You can be profitable even if you have 30% of successful trades. Also very important thing about money management is the more capital you expose, the higher the risk. But guys, with high risk, there is potentially higher profit. That is why we can use leverage to its maximum. But I don't say use always the leverage to its maximum. It's good to know when to use it and when not to use it. You should never abuse it. So if you have 1 to 500 leverage set on your trading account, what I recommend, you don't need to trade with 1 500. You can actually trade with 1 to 20, 1 to 50, 1 to 100. Okay? That is very, very important for you to say and for you to know. And it's very important also for you to know that only in extreme circumstances you can actually recuperate yourself and your account if you know how to use 1 to 500 leverage to its full potential. But you need to know when to use it. As a trader, you need to assess the best trading opportunity and go for a big win instead of risking a high loss. Okay, so now I will show you, I showed you tripod of successful trading. We talked about market volatility, and now it's time to explain what leverage is, because I'm sure that you guys don't know what leverage is. So the leverage is a great thing that brokers provide you with. Also, you need to know that brokers provide you with more money than the balance in your account, and the leverage works by establishing a rate you can use for every euro or dollar in your account. The money you put for a trade is actual money you risk. It's called margin. Okay, this is also important, guys. You need to understand what margin is. Okay, if you don't know what margin is, guys, please go to the basics of forex trading. But this is the basic definition. The money you put for a trade is actual money you risk. It's called margin. We use leverage to increase profit potential, not to overuse profit potential. Okay, so that's important. You're not gamblers. Okay, you're not gamblers, guys. You need to understand that the leverage is used only to increase profit potential. Total position size divided by the account equity equals to effective leverage. Okay, now if you don't understand this, please snapshot the screen, okay, and it will be easier for you also to calculate it yourself. So total position size divided by the account equity equals to effective leverage. For example, equity equals to 10,000 euros. Total position size equals to 50,000 euros. When 50,000 is divided by 10,000, you will see 5. So it means 1 to 5 leverage. Okay? So that is how leverage is calculated. You need to divide a total position size with the equity to get the effective leverage. For 1 to 100 leverage, we need $1,000, and let's say that we have a contract then of $100,000. Now, if we make 100 pips of standard lot, we would make a profit of $1,000. That's because for every dollar in contract, we made $1 cent. 1,100 times 1 cent. If we make a loss and the value of contract drops to $99,000, the deal is off. Okay? Then, in order to protect brokers from a loss, you need to guarantee with some money. So you guaranteed, guys, with $1,000. It's easier for me to go with dollars because, you know, every pair has its pip value, and we can round it up, but you can actually understand the basic principle. Okay? Now, we always guarantee with some money, and we use leverage to make profits. Because, guys, if you traded without leverage on $1,000, you couldn't make anything, literally. So you need that leverage. In my opinion, leverage 1 to 500 is still the best, no matter what, because it gives you the opportunity to make higher risk trades. I said it here, guys. More capital exposed, higher risk, potentially higher profit. But also you don't need to do that, because if you have low risk, you still can use your leverage to its full extent. But you have the chance to place a high risk trade if you want to risk higher. Okay, if you want to risk higher, you have the possibility to risk higher. So that is why leverage 1 to 500 is the best, but you need to know what you should do in order to use the full potential. So guys, in this example, I can use the leverage of 1 to 5, 1 to 10, 1 to 100, but I personally am not limited to using 1 to 500 if I want to use it. You understand the point? Because sometimes, guys, I am very sure about my trade. Let's say today, if you traded pound dollar, I hope that you took a pound dollar setup that, because guys, master candles, breakout candles, I will show you money management rules later for breakouts. Definitely it was one of best setups for master candle. If you traded this setup today, you could have made really nice amount of pips initially. Even though if you traded a little bit later, you could have made more than 20 pips in a single hour. That is because master candle is a breakout trade. And when you are sure of your trade, when you know that something will be breaking out, you can use a little bit of risk to actually propel your profits. So that is why bigger leverage is good if you know what you are doing. Of course, for new traders, they should keep within the boundaries of lower leverage, but really for experienced traders, I still think that the experienced traders should use 1 to 500 leverage. At least you guys will risk your money, so you know that you are risking your whole account. Okay. Now, next thing, guys. Leverage exists, okay? Leverage exists to create a possibility of making bigger profits. It's provided to you in order for you to use the advantage of the leverage. If you don't know how to use the leverage, you should definitely practice it on demo account first. Okay, demo account first. It's very important. Demo account will also show you how you can master your leverage to its fullest potential. Okay? It's necessary because Forex trading involves a very small price difference. So it's necessary to have leverage. It would take a very long time to make a meaningful profit or investment. Using leverage, you get a return of your investment much faster. For example, I really like to use, guys, personally, I like to use a big leverage on lower accounts. For example, if I open a mere $500 account, that is, I like to use those lower accounts from time to time because it gives me, you know, the good way to trade and to actually double it. So that is why I really like to use a big account. So this is one of leverage accounts that I had with Admiral Markets, 1 to 500 leverage. Okay, here the deposit has been made, so You see, this is my account statement, and this is what happened after I used 1 to 500 leverage, guys. I mean, easily, you see here, guys, it was a lot of trades, more than 100 trades taken. Of course, guys, I needed to use big leverage, but eventually I doubled the account. Now, this is my example. I know what I'm doing, guys. Okay, I know what I'm doing, and I don't care really if I lose this money. So that is what every single trader needs to be aware of. Okay, risk disclaimer always exists to warn about potential risks. So people and traders who are not, who simply don't want to comply with the risk, they don't need to trade. I mean, who guarantees you that even if you made same trades that I did, you would make the same result? That is why I always say we can all trade the same system, but the result will be different. I will be using 1 to 500. Some people will be using 1 to 100. Some people will be using let's say scaling out. Some people will take all profits without scaling out. Ilya is saying he doubled his 500 account with Monday setups this week. You see, guys, some people lost something on Monday, but Ilya actually made it double. Okay, so you see, some people lose, some people win, and I'm glad that Monday setups came well. Of course, for me, New Zealand dollar was the best, but at least you made it. So well, I didn't use my setups for this account. This was something different, but I wanted to tell you guys that the biggest thing about leverage is to understand, guys, to understand what you should do in order to make your account in a good profit. This account had a maximal drawdown of 60%, but guys, I was ready for it because I used this leverage to make this in very, very short time frame. Maybe if I traded with 1 to 5 or 1 to 100, I could make it, but guys, it would have taken so much time to make it. So even though I could use maybe a little bit less leverage, but I still had the opportunity, you see here, to recuperate my account. Because at this point, guys, at this point, my account was in a loss. But guys, by using the leverage, I managed to double the account. So that is why it's very, very useful to understand that leverage concept should not be misused. Leverage concept is something that you as a trader should profit from, should make a good profit of. Not a loss, but a profit. You will be exposed to a bigger loss than if you use a lower leverage. But still, it needs to be your own decision. Okay, now, I recommend usually no more than 5 to 1 leverage if you want to do it with let's say like banks do. But then again, guys, well, if you want to risk more, still you have the possibility to risk if you set your account to 1 to 500 leverage. It will give you the possibility to trade with 1 to 5, but also 1 to 500. Let's say that usually if the account balance is $5,000, well, we usually take 0.25 lots, okay, because 1 mini lot is $10,000. Proper risk is 0.5 to 1% per trade. It doesn't matter if your stop loss is 30 or 100 pips, because stop loss is dynamic and the risk should be fixed. You move your stop loss according to price. You cannot say that euro dollar stop loss is the same as pound yen, because pound yen can have a higher stop loss, guys. Pound yen should be at least 50 pip stop loss. For euro dollar, we can go with 30 pip. So that is why, but you know, sometimes we can also make 20 pips, sometimes we can make 50 pips for euro dollar or pound dollar, it doesn't matter. It depends on ATR, on the candles, on high, lows, swing high, swing lows. So, you know, but you can also put 100 pip stop loss fixed. Always use 100 pip stop loss, but you don't need to use more than 1 or 2% per trade. So what I'm implying is you do your own trade management. It defines your personality as a trader. I know some traders that use always 100 pip stop loss, but they put 2% of risk always in 100 pip stop loss. So you can do it also like that. But this is the risk formula, guys. Stop loss times the leverage divided by 100. If stop loss is 20 pips, so 20 times 5 divided by 100 equals to percentage of risk. So in this example that I'm showing you, let's say 1 to 5 leverage, stop loss is 20 pips, leverage is 500. So if you divide it by this, you will get a proper risk amount. Okay, that is the formula for risk. Now, this is what can happen if you actually, well, guys, if you misuse the leverage. Account equity in the first example is 10,000. In the second example, it's completely the same. Lot size is, let's say, also the same. We use 50 10K lots. The leverage was 50 to 1, and here the leverage was 5 to 1. They both experienced the same stop loss of 100%. Because of higher leverage, the first trader lost 5,000 euro, while second trader lost 5,000 euros. So see the difference, guys. Okay? This is very important. So when I say use big leverage, I say start with small leverage. If you lose your trade, then next trade could be a little bit higher leverage. You still have the chance to be within the risk threshold, but because your leverage is 1 to 500, you have the chance to make up for your losses, guys. If your first trade is leveraged to maximum and you lose the first trade, you are risking a loss that is very hard to recuperate. That is very, very, very important, guys. My first trade is always with a low leverage. And if I make a loss, I still have the chance to actually use the bigger leverage to make up for the loss. Okay? Now, this is also very important, guys. Let's use this example. If you risk 2% of total account per trade, and let's say you started with 5,000, even if you had 10 consecutive losses, guys, you would have lost only 17% of the account. That's manageable. That is very, very manageable. If you had the same thing, but you had start with $5,000, but you risk 10% per trade, then guys, your account would have been 60% in a loss. That is why you should not start with 10% of risk. Start with 1% of risk or even lower, so you can add up by exploiting your leverage to the maximum, guys. Remember this. You should be successful if you know how to place your risk in a proper way. 1 to 500 is still the best, but let's see this first. Overall risk should be 3 to 5% per day. Extreme risk can be 10% per day. Novice traders should limit their risk to 2% per day. Divide all position per risk. Positional trades 3% maximum risk. Counter trend trades 2% risk. Breakout trades 3 to 5% of risk. Scalping 2 to 5% of risk, and extreme trading 10% of risk. Remember though, above 5% of risk, you are in danger zone. And the rule of the thumb is, if you want to make 100% of your account, if you want to double your account, you need to be ready for a risk of 100%. So if you want to make 100% of profits, be ready for a complete risk of your account. You need to be aware of that. So if you make positional trade, divide your positional trade into smaller trades. For example, I want to make 5 positional trades in a single day. I would divide 3% of risk by 5. Okay? So my average risk would be 0.6% per position. If I want to risk a little bit more, 10%, okay, then I can actually divide 5 different positions, placing that every single position has 2% of risk. If I do 3 to 5, if I want to make breakout trades, I can put everything in a single breakout trade. Actually, guys, I traded my pound-dollar setup today. I made 20 pips, and I risked 3% of my account. I even wanted to risk 5%, but I actually risked 3%. Sometimes even myself, I can afford to risk 10% in a single account, in a single trade. But that is usually when I am very, very sure about setup and I want to risk really a little bit higher than I used to. But I rarely go above 10%. Really, it's very, very rarely. Usually my risk is low. If I want to, let's say, if I really have invest a low account, if I have 200-300 euros, that is for forex trading, extremely small account, then really, guys, I can even go with much higher risk, because that is me, guys. I can afford to lose 300 euros. Some people, guys, of course, if 300 euros is much for you, or 500 euros, then you should stick to 1 to 2% rule per day. I personally traded also on higher accounts, 150,000 pound account, and the rule of thumb was not to risk more than 2% per day. So, it all depends about your risk management, your risk rule. Your risk rule should be defined by your trading plan. If you don't have a trading plan, you should make it, and you should definitely stick to it. From this slide, by using this slide and by using the rules that are presented in this slide, you can see that I put the biggest accent on breakout trades for a risk. Breakout trades, guys, are trades. I like these master candle breakouts. And when I see that there is a breakout impending, let's say that there is some pattern that we trade, maybe we will trade this live on Wednesdays. If we see some good patterns to trade, then, guys, I can put a little bit more of a risk. But if I lose the trade, then I'm done. I cannot recuperate. I cannot make additional trades. But if I lose, let's say, counter trend or positional trade, I still can make 1, 2, 3 trades to make up for the loss. This is maximum number of risk, maximum percent of risk you should use for different trading styles. Okay, this is not for per trade. This is maximum number per all trades. So if you want to make 2 positional trades, then use 3% for the whole positional trade you open. So if you open 3 trades using different pairs, then divide it, let's say, 1% for each trade. If you use 3% for each trade, you would be very close to extreme trading. That is 10%. That is dangerous, guys. If you want to risk 5% per day, you can make, let's say, a full position on 1 counter trade, let's say risking 2 position, and you can divide positional trades by 1%, to have 3% maximum. So you can make one counter trade and 3 positional trades, but you will still be using 5% of risk. Or you can scalp. If you scalp by using 5% of risk, then be ready for extreme trading if your first position that was 5% of risk goes in a loss. Okay? Mario is asking cost benefit for master candle break. I don't understand. What does it mean, cost benefit for master candles? Please rephrase the question, Mario. I really don't understand. What does it mean, the cost benefit? And the most important thing, guys, is you need to know that above 5% you are in danger zone. It's up to you. If you want to be in a danger zone, if you want to trade with bigger risk in order to make bigger profits, then guys, you need to be ready for 10% of risk, and some people even risk more than that. I know that. Even though they know all about this, what I've been talking to you, they still want to risk more than 10%. Okay? Now, 1 to 500 is still the best, because 1 to 500 actually gives you the opportunity to trade from 1 to 500 to 5 to 1 to 500, because this is the maximum leverage, but you don't need to use that. You can go with lower leverage, but this will give you the opportunity to make up for losses. So for me, it's still the best option. You need to know what to do. Definitely, recovering is much easier, and some traders like to risk more. I personally, from time to time, risk more. From time to time. Now let's see the example, guys, on a live chart. I will show you this. This is live chart example, guys, and you can actually see that I have mini terminal here. So guys, if you click here, you will be able to see different fixed loss size, stop loss. You can do everything with mini terminal that is provided by Admiral Markets platform. It has so many options that we already covered, so you can divide your risk. You can really do whatever you want with your risk here. I also like to use so-called money management calculator, that when I put risk percent and stop loss, it gives me a possibility to calculate the position for a trade. Yes, this is something updated. Ilya, you can actually click here. Let me show you this first. You can click here. You see settings, margin calculator. Okay, here. And also you have like this, you see? So you can actually undock chart. You have margin calculator. This is margin calculator, if you think. So everything is covered. I mean, it gives you tons of options. Okay? So you can use it however you like. But let's say this account is 63,000 euros. If you go to a money management calculator, and let's say I want to risk 5% on position, and my stop loss is 30 pips, when I press OK, it will print out, well, this is not my tool, but this was free to use it. So you see, it gives you calculated lot size. I personally don't need to use this because I know it's always in my head, proper risk management, and I know it by heart. I don't need any calculator. But if you need this, I can provide you with this calculator. Martin, you can send an email to me for a calculator, so I will send you. You still can use mini terminal. Here, really, it's very, very easy to use because let's say it will calculate the percent of equity to place an order, to trailing stop, taking profit. You can use percent of equity, percent of balance, fixed cash risk, fixed loss size, whatever you want. So I still advise you to use this tool, and I can also send you my money management calculator. So guys, the question was from Mario, how much risk you have to earn how much? For master candle breakouts, I don't care about risk to reward, because simply said, for master candle breakout, so we had a breakout today on 1 hour time frame, and actually this was the breakout here. So I just simply see if I want to scalp the trade. So let's say that this was the breakout, it happened here. I knew this was resistance, but I also knew that if this breaks out, at least it will go 10 to 15 pips in profit. That is how much I was willing to risk. So I put I placed the order, and I took 20 pips of profit, and I was very, very happy with it. It even went higher. It went, you see, to 25.48, but I was stopped out a little bit lower because I moved my stop loss there. But still, you need to decide ultimately whether you want to trade breakouts or not, because breakouts are a form of scalp trading. You need to know about it. Breakouts usually are short trades where you take the trade and you close it very soon, because you don't want to make positional trades. Are different. Breakouts are different. Okay, breakouts, you make price breaks out of consolidation. It can be breakout trigger happy, breakout retest, breakout retest continuation, or breakout pullback continuation. I usually do trigger happy trade. It's called when I instantly place buy or sell order after master candle breakout, and I can usually see what my profit will look like after, let's say, a couple of minutes, because if it breaks in direction that I placed an order with, it's usually an instant profit. I traded, Ilya is asking, why did I trade breakout on Ilya? The simple thing, I traded breakout because I wanted to make profits. And I gave you my analysis on session recap saying that pound dollar was in uptrend, and it was, and it still is in uptrend. And the reason why I traded breakout for me was very clear. This is the reason why I traded breakout. This was intraday setup. I can take a look on higher time frames, but I don't care. I don't trade daily time frames. My time frame of choice is 1 hour time frame for day trading. So here you see, this is the reason why I traded breakout, because I had a master candle here on 1 hour time frame. Okay, this is the reason, and I actually pasted it here, and I will be still long if the price gets here. Okay, so you know, it's different style of trading. Some people like to trade differently, but I simply follow my own rules, my own money management, and for intraday trading, definitely pound dollar was very, very profitable. Here you see, guys, it's actually V-shaped reversal, cup with candle pattern here, bullish pattern, master candle. So a lot of good opportunities. On daily, it's kept at EMA 89, but I didn't need to watch daily to know that this is resistance. Of course, this is resistance because this is previous resistance. It's close to H3, but still it was good for 20 to 30 pip of profit. So after all, you need to know what you want to do, whether you want to short or long. I know that I might be a rare analyst and trader who actually went long, because I read many analyses that pound dollar should go short, but I was right again. So yeah, I mean, very, very, very good setup. And if it drops to POC, I will go long again. So you see, I traded breakout with slightly high risk, but then that was my own decision. I didn't wait, guys, I didn't make up this decision for other traders. So ultimately, it will be you who take those decisions in the market. It will be you. So you can still use 1 to 500, but I advise you to start with lower leverage, and if you are sure in your trade, then try to use slightly higher leverage. I usually use the benefit of higher leverage to make up for the loss if I make it. So let's say that I made a 30 pip loss and I lost 3% of account. If I say next day I will use 5% to make up for a loss that I made previous day, I will use higher leverage because it allows me to do that. Ilya is saying that he is very pleased how DEX bounces on T89. I didn't follow it, but I'm very glad, Ilya, that you notice it. You can send me an email of your observations about my T89 pattern, and I will take a look at. So please write an email and send and tell me your observations about T89. So I will be very glad, because I don't follow DEX on a daily basis. So yes, if you have, yes, the time, I will take a look at it, and I will be very glad to explain also other traders what they should be looking at. So guys, this is everything I had for you today. I hope that you enjoyed it. You really need to be aware of money management. If you don't know anything about it, then you have a great tool on Admiral Market. It's called Mini Terminal. If you still don't know, guys, anything about it or how to use it, I will send you the script. So you just need to, well, just send me your email, or just send me an email, and I will definitely send you my risk calculator. As I said, I didn't make it, but it's good. It's very simple to use, and yes, I can send it to you. Okay, guys, so let's see if we have any questions left. Let's see. I don't see any questions, so we might assume, okay, let's see. Ro, please send an email to me asking for the indicators. I will definitely send to you, but you need to send an email. Ro, send an email, please. Yes, maybe I'm busy, but I will try to reply just a little bit later. I will reply, guys, so don't worry. Eustace is asking, how should I protect my open trades over weekends? Well, the best thing is, if you are in a position, try to lower your risk. Still, Eustace, if you are having a high risk trade, then you need to comply with the risk, because trading over, carrying the trades over the weekend usually brings higher amount of risk, because you might open with a gap. I mean, the market might open with a gap and you might lose. So if you carry over trades on the weekend, I assume you use swing trading, and if you use swing trading, your risk should be really not higher than 1%. Or let's say maximum 2%. But you need to actually cut your risk. If you're in profit, if you're in a loss, well, then you need to decide what you would do. I would personally, if I have a risk, a trade running over the weekend, I would definitely look to cut my risk prior to weekend. Okay, guys, so this was it. This webinar is recorded. It will be uploaded. I wish you a great day, and talk to you soon, guys. Cheers and trade safe.